You have questions, we have answers. This is Jane Muller.
And this is Ken Muller. Welcome to our show, all about real estate with Ken and Jane. Today we have as our guest Ajay Kumar, CPA with SAI CPA Services. Ajay, welcome to our show.
Thank you, Ken. Thank you, Jen.
I should say welcome back.
Yeah, welcome back. But yeah, this is probably the second or the third time.
Last year, the year before, right?
Yeah, I think this might be the third anniversary.
Third
right?
one, yes.
So the first show this week, we're going to discuss some of the tax laws as they apply to real estate transactions for principal residence and investment properties. But I want to preface the discussion by saying this is meant as general guidance. If you have specific questions, the only one who can give you that advice would be your individual tax accountant. So
yes.
We're going to preface that. This is just as guidelines. Don't go listen to the show and everyone's situation is unique and you need personal attention.
And
if you need help, you can contact Ajay directly.
That's right. Now lead to the phone numbers.
Yeah,
absolutely.
So tell us about your firm and your contact info for this.
SAI CPA Services has been in business for 25 years.
Wow.
I have MBA in finance, CPA, wealth planning license, business valuation licenses. We have 83 accountants in the firm. But again, the advice that we are giving right now is only general in nature. In the same situation, let's say if you say I sold a property for $1 million, how much is my taxes? It depends on your income tax bracket. It depends on if you're doing married filing, joint or single. It depends on your primary home or investment property. So the advice that we can give in this 30-minute session is only general in nature, just to start the thought process, just to give you more information. So you can research into it, or you can go to your accountant, your CPA, your tax preparer to get more information and hopefully save a penny.
Right. This is just to ask the right questions, to ask your accountant and say, hey, I sold a principal, what I think might be a principal residence in 2025. What are my taxes? You know enough of the questions to ask them, or hey, I have an investment property. Can I deduct, X, Y, and Z?
Absolutely. Very well put.
Yeah.
You know what? A lot of time, right, Ajay, for the for accounting the tax issue, right? Save a penny is absolutely not worth it. Make sure you have the right advice, so otherwise you don't want the IRS knock on your door. Just sometimes I feel the people may not deliberately did anything. They just didn't understand because the accountant do everything. You just sign the name and filled it in. But when the problem happens, and you as the taxpayer, you have to answer it.
100%.
You can't
the person
blame
who is signing
others.
the tax return as a CPA is not on the hook to justify the numbers.
Yeah.
These are your numbers.
They're your numbers, right?
As a tax payer, you are responsible for your numbers, and you are saying it rightly. If you pay more taxes than what you should have paid, nobody's coming back to you telling you, hey, you paid more taxes, here is your money back. But if you pay less taxes than what you should have paid, the system is willing and ready to come back to you. Here is the taxes, here is the interest, here is the penalty. So you are responsible for
yourself.
Yourself,
right. And
in China, there was a few famous movie star, very famous. And, somehow, there's always two-side story. And they were so busy what they do, plus they claim they not really, tax law or accounting expertise in that nature. So they just did whatever the team suggested. She just signed her name. At the end, will not be in jail. And then later on, the government changed the rule. So whoever happened again, they have a life sentence, but just pay back. That's it. Fine first time, you pay back the fine, whatever. But there was a very, very famous person, the icon. I went to jail because of that. Because, a lot of time...
I'm sure in this country, too, Ajay, you can speak better, too. If you forget to file your taxes and you owe money, there could be obviously civil penalties, but also criminal penalties. I remember
there could definitely be criminal penalties.
Years ago, there was a mayor candidate for New York City that just said he forgot to file one year. He didn't.
How can you forget to file? I don't understand
That doesn't make sense to me. But doesn't make sense. But that was the defense he used at the time. So... It's crazy. So let's talk now about the one of the golden rules with the IRS is the IRS principal residence rule that allows some capital gain to be tax-free if you qualify for all the criteria.
Right.
So let's talk in guideline terms generally what it entails.
Absolutely. So if it's your primary home that you sold, this year, and you have been living in that house for at least 2 years in the last 5 years as your primary home, and they decide by looking at that this was the address that you used on the tax return as a primary address, this is the address that you have on the driver's license, and this is how they are deciding if this was your primary residence or not. If you have been there for at least 2 years in the last 5 years, the capital gain up to $500,000 is not taxed, assuming you did not really try to use the home as a business. Meaning some people, what they do, they have home office and they say 10% of the home is used for business and they are trying to claim 10% of the mortgage, 10% of the property as depreciation. In that case, that 10% is business,
Right.
not primary. So you have to pay capital gain tax on that 10% of the transaction if you used part of your home for business. So if you intend to sell your home in next couple of years, please don't claim any business expense around your home office.
But you could, and then you could work around it legally. It would just be
That's right.
It would just reduce your tax-free capital gain, assuming you're under $500,000 of capital gain for a
Absolutely.
married couple.
Let's say if the
Yes.
capital gain is 300,000 and you have been using 10% of your home, so you still end up paying taxes on 30,000. 10%
Yeah,
of
and
that area.
270 would be
Exactly,
would be
is the exempt
tax-free
amount.
capital gain. Yeah,
And this
then,
$500,000 is married filing joint limit. If it's a single or married filing separate,
Yeah.
then the tax-free capital gain is $250,000.
Yeah.
Yeah. Again, just a sidebar. It seems like there's no real advantage to married filing separately, yet they have that category. Maybe there are some advantages,
There
but it
are,
seems to me like
Not in this case. Let's say if you have one spouse who is working in California, the other spouse is working in New York, meaning and that they're maintaining separate residences. In that case, you don't want to be exposing the California income with New Jersey taxes and New York income with New Jersey taxes.
okay.
So especially when you have multiple states involved in a situation, in those cases, it makes sense to file separately. Or if you have a risky business, wife owns the business and it's a sort of financial business or a risky business, you don't, and husband has a lot of assets under their name. By married filing joint, you don't want to bring everything together. So there are special circumstances when it makes sense to do married filing separate. But in most cases, married filing joint will save you more taxes than married filing separate.
And thank you for the explanation.
Yeah.
I always wondered why they want us. I mean, unless they going separate way,
or there might be
I mean,
couples that keep everything separate. They might just prefer that way in case they ever
then,
decide to separate.
Even then, we can do jointly and calculate if you have done separately, how much refund would you have received, and we can help them divide the total refund.
Yeah.
Even if
Yeah,
you're
you
doing
can do it
married
that way,
filing
right?
jointly.
But I'm sure you work with so many different types of clients, and you may have those couples where they keep everything. They have separate bank accounts, separate investments.
it's not
and yet
uncommon.
They're married, but it's not. Yeah, well,
It's not uncommon.
Yeah. So,
Well, we are the boring type. Everything together. We're a boring
say
type.
what's mine is mine. What's hers is mine.
Yeah.
Yeah.
I tell you, with us, right, I don't know what I'm signing. So a lot of
older
time, right,
generation.
I used to joke, right, I said if I responsible to pay for the bills, our house will be foreclosed a long time ago. And the first of all, I probably didn't pay the property tax. And then
Well, now everything
else,
is on auto pay, so
Yeah,
I just do
that's
it.
good.
That's the beauty of it with the
Yeah,
township.
yeah,
You can set up
absolutely.
auto pay, and for
Yeah.
like different investment properties, you can do that too. So you don't have to worry about writing thousands of checks every.
See, I don't do anything, so I want to know.
Yeah, or mortgages can be auto. That's all. That's
Yeah,
the beauty of
everything
the,
In
automatic.
our generation, 50 plus, we see a lot of people where things are managed together.
Yeah.
Yes.
As opposed to newer generation, where we see your money is your money, my money is my money type of deal.
Oh, Generation Z.
Yeah,
whatever the
right.
youngest one they call it now. I don't know.
Right. So they have separate accounts, separate understanding.
Yeah.
But in the older generation, we still have a lot of people where everything is managed by one person.
Right.
It's easier.
Yeah.
It depends. It's the mentality.
It depends on the mentality,
Yes.
right? And then I'm sure you have wealthy clients that have prenuptials, and then it gets
Exactly. Yeah,
complicated
right.
with that whole
Right.
too.
That's hairy.
Yeah, so then they want to keep it separate for accounting reasons too. So let's talk next about if you're selling a home and it doesn't qualify and you do not qualify as the principal residence exception, how is the gain, the capital gain, calculated, and what is the percentage rate in general guideline terms?
Absolutely. So if it's an investment property,
Yep.
if it's a property that's not qualifying as your primary residence, in those cases, like any other asset, You sell the property, we calculate the basis, the cost basis, how much you purchased, what capital improvements you have done, minus the depreciation that you have claimed. That's your cost basis versus what you're selling it for. And the difference is the capital gain. If you have had the property for more than 1 year, it's a long-term capital gain. If you had the property for less than 1 year, it's a short-term capital gain. Short-term capital gains are generally taxed at the regular income tax rate, which varies from 10% to 37% currently.
Okay.
Long-term capital gain, meaning more than 1 year, are taxed at 0%, 15%, or 20% at the federal level. So when we talk about taxes, there are always two sides. IRS, meaning the federal government, and the state government.
Sure.
So the IRS, the federal government, has multiple tax rates depending on how much income somebody is making. And those rates varies up to 37% for the regular income tax rate. Regular means less than 1 year of the transaction. If it's more than 1 year, the maximum capital gain tax rate, long-term capital gain tax rate could be 20%. And then there is a net investment tax about 3.8%, but leave that aside.
Right.
The income tax, capital gain long-term is 20%. The problem is state of New Jersey does not recognize capital gain. Everything is regular income.
I see.
So when you sell a house or investment property, you pay not only the IRS, you pay New Jersey as well. And New Jersey has similarly their own tax bracket varying from 1.4% to 10.75%. More income you have, higher the tax rate you have. There is no separate tax rate for capital gains. So at IRS level, there's separate tax rate for capital gain, separate tax rates for regular income. Capital gain tax rates maximum is 20%. Regular income tax rate is 37%. For New Jersey, everything is maximum 10.75%.
Okay.
Oh, wow.
It's very
That's a
interesting.
big difference.
So it's very advantageous if you have a prime residence that you stay there a year, because let's say you're making $750,000 a year, and for whatever reasons you have to sell the house after living there for 9 months. So in that scenario, you could be taxed if you sell the house and there's a gain. You could be taxed at the 37 percentile rate on that sale because it's less than 1 year.
It's a short term.
For the federal level.
It's a short term. It does not qualify for the exclusion.
Right.
Because you have to be living there for 2 years.
Right. You live there 9 months, let's say.
So it's
that's
9 months, less
that's a
than
big
1
hit. So
that could be a huge hit.
Huge hit.
The problem, the key here is, let's say if you are making $750,000, and if you sold the house within 9 months, then more than likely you don't have a large capital gain.
Too, yeah.
So you just bought the house 9 months ago with all the closing costs, everything
that's
else
true.
that you
That's
improved.
true.
That's true.
Yeah.
Unless you.
So the capital gain is calculated based on the selling price minus the cost basis, minus the purchase price plus improvement type of difference, not on the selling. Let's say if you sold the house for 1 million, we are not charging you on 1 million.
And you can deduct the commissions from the
Absolutely.
realtor. You can
That's-
deduct the
that
attorney
helps
fees,
you.
all the
Absolutely.
costs that you paid for the
That's
house
the
get
idea.
added to your basis too. So it might be a minimal, maybe a few
Exactly.
thousand. If
So in
anything.
9 months, you may not see large capital gain
Yeah.
anyway because you had to pay a lot of fees, attorney fees, closing fees, mortgage fees. And then as soon as you got in the house, you had to fix few things, you had to improve certain things.
Yeah.
That all increases your cost base.
have
Most
nothing,
likely you lose.
Yeah.
In this case, right, they probably can can claim the loss. Say,
They-
for
they can.
example,
They can.
when you bought
Investment
a house,
That's true,
you
yeah.
have the closing
Yeah.
costs, you have title, you have the lawyer, everything,
Yeah.
and then you have mortgage
Mortgage costs,
application.
you may have mortgage
and then when you
interest, too, if
close,
you-
you have a realtor's fee, you have all these fees, add on the. I mean, I always tell my client, you're lucky
You have a
you
realty
break
transfer
even.
in New
Yeah,
Jersey.
yeah,
You have a
yeah.
realty transfer tax,
Yeah.
which we're going to talk about next
Everything.
week's show,
Absolutely.
and also
Yeah.
maybe even the mansion tax, which
Yeah.
changed with the graduated scale. If
Absolutely.
you're selling over $1 million to, up to-
Yeah,
It
there's
all
a lot
adds
of
up. It
fees.
all
So it
adds to
adds
the
up,
cost
and
basis.
now that's on the seller side too, the burden on that.
That's right.
So you have two
Yeah.
taxes on the seller. You have the realty transfer tax and the mansion tax.
Yeah,
which kicks
absolutely.
in at certain things. Yeah. So that's good. So it's very important then for the cost basis that you keep records of all the home improvements, right? You want to keep records, and you, I think last year's show you mentioned you want to make sure you pay by a trackable method, not by cash.
If
Remember
you're
that was-
paying by the cash, then you have no way to really prove
it.
that you paid.
Yes.
Yeah.
That's why it's important to pay by check. Let's say if you have a situation when somebody wants cash only, they will
Yeah.
not do the work.
Yeah,
Even in that situation, first you try to avoid that situation. And if you have to, you make sure you write a check. And if you have to, you make sure you write a check. And then as soon as you got in the house, you had to fix few things, you had to improve certain things. That all increases your cost base.
Mm-hmm.
So in 9 months, less than 1 year, you may not see large capital gain payable to cash. And in the memo section, you try to put their name, their address.
Yeah.
I put as much detail as possible, attach an invoice around it. At the end of the day, you put yourself in the auditor's shoes.
Yes.
And you ask yourself, is it a justified expense or not?
Yes.
Yeah, for
Absolutely.
such a big expense, you'd want to pay by credit card or
Credit
check.
card,
So have-
absolutely.
yeah, you need it. Yeah. All right, let's get started. We'll talk next about investment properties. Before we go to break, we'll just touch on that. So there's a lot of deductions for investment properties or rental properties where the owner is the landlord. Let's start to talk about some of the things, the allowable deductions on that to offset the rental income that you get on a year, like repairs. and all that.
Absolutely. So if you have an investment property, make sure you maintain the right receipts. Make sure you pay as much as possible all these expenses via trackable method, credit card, check. But right from renting it out, and if you had to pay any commission to the realtor or anybody else, that's a deductible expense. If you have any mortgage interest, that's deductible. If you have property tax, that's deductible. If you had to do some cleaning, some fixing, some repair, that's all deductible. You ask yourself a question, would I have had this expense if I did not have this property? Meaning, are you having this expense only because you have this property? More than likely, that expense is a deductible expense for this investment property. I'll clarify that a lot of people get confused. The mortgage interest is capped for indebtedness of $750,000 for primary home. So if your mortgage amount is more than $750,000, you don't get the full claim for the mortgage interest on your primary home.
I see.
But on investment property, there is no such limit.
Yep.
I see.
On investment property, your mortgage could be a couple of $1 million, and you still get the full mortgage interest deduction.
Okay.
And then you have to have some sort of, let's say if you have condo association fees, that's all deductible. You wouldn't have had the condo association
Right,
fees if you did
management
not have
fees.
this property, management fees.
Pest control.
Absolutely. And
Okay.
anything that relates to
We're
it.
going to go to break now. When we get back, we're going to talk about depreciation, how that
Absolutely.
plays in. So stay with us. We'll be right back. Okay, welcome back. We have Ajay Kumar, a CPA with SAI CPA Services, as our guest today. And Ajay, please give your contact number.
Absolutely. Please call us, SAI CPA Services. We are located in East Brunswick, Monroe, Princeton. You can call 908-888-8900 or 908-380-6876.
Okay, thank you. So getting back to investment properties, we talked about before the break about the repairs, management fees, property taxes, pest control, all those allowable deductions. There's also this magic thing called depreciation that's deductible, whether you have a residential or commercial property. Let's touch upon that topic.
Yeah, absolutely. So the depreciation depends on if it's a residential property or a commercial property. If it's a residential property, depreciation is 27.5 years long. Meaning if you bought the property for, in this example, $275,000, your depreciation is going to be $275,000 divided by 27.5, meaning roughly $10,000 per year. You also have to see if you bought the property, let's say on April 1st. So the first year you are getting 9 months of depreciation, not for the full year. If this property is a commercial property, Dollar General, Starbucks, location, a real estate, then you're supposed to take the total real estate value and divide it by 39 years. But please make sure when you have this depreciation calculated, keep proper record around it. What happens? It reduces your cost basis. When you sell this property, this depreciation gets added back to your capital gain.
Meaning, and by doing that, it meaning that if your cost basis, let's say you bought the property for $200,000, but you claimed $50,000 in depreciation, your cost basis gets reduced by $50,000. So it's instead of being $200,000, it's $150,000. So if you sell it for $300,000, there's more. It's a bigger exposure.
Absolutely. So the other way to say the same thing, you bought the property for $200,000, you're selling it for $300,000. So you think your capital gain is $100,000. But if you have claimed $50,000 of depreciation, it gets added back to capital gain. So now the capital gain is $150,000.
Right. So you can't have your cake and eat it too. There's always that's something I realized early on
Absolutely.
that if you do
Absolutely.
sell them, that's why it's
a
good.
lot of people make that mistake. A lot of people get into
They think it's the
trouble.
best thing in the world, depreciation, which is great. But once you sell it, you got to pay the piper back.
Absolutely.
And then in my study of the CCIM, I learned that when you have taxes on commercial property, you pay a tax on the capital gain and you pay a tax on the depreciation. That's how they
the capital gain is calculated in adding depreciation back
in, right. And then
this is the total capital gain.
And then
the confusion comes from the fact that New Jersey does not have a capital gain tax rate. For
right.
New Jersey, it's all regular income.
It's regular income, yeah.
For federal government, in this example, let's say you bought something for $200,000, sold it for $300,000. So you are thinking capital gain is $100,000, but you are adding back $50,000 of depreciation. So we are telling you your capital gain is $150,000. So the federal tax, depending on your income, could be 0, 15, or 20%. For New Jersey, it could be anywhere from 1.4% to 10.75%.
And that gets added as income to your overall income, and then your tax based on whatever your total income is and the charts.
That's how you calculate in New Jersey.
Oh, interesting. Okay. Yeah, that's a lot of, But I think investment properties are a great source of...
it's a tangible asset.
Asset, yeah.
So it doesn't really fluctuate as much as people want to invest into REITs, real estate investment trust, and the stock market and everything else. Real estate, physical, tangible real estate has been consistent performer. It can go down, but doesn't. Generally speaking, stock markets have a lot of fluctuations. Real estate is also seen as safer investment,
right.
Something that you can feel, you can touch, and you feel some control around it.
Right. In our training, it's mid-range. It's between bonds and stocks. It's like a middle range investment.
Yeah, I think it's just like a diversify. You can't put all the egg in one basket.
100%.
So you should have a little bit of each, right? I used to joke with my investor client. I said, well, when you buy the stock, right, when they hire a CEO, they're not going to call you for approval. But if you buy investment property, I definitely call you for approval, which tenant you're going to accept. So you have a more
more manageable control over the asset. Whereas if you're investing in a stock, you're trusting the company and whoever runs the company that they're going to, or mutual funds, you're trusting the people. And if you buy private investments, then you really could risk, the Ponzi schemes that are out there. And it gets
Forget about Ponzi scheme, Ken. Just think about it, right? Oh. Sometimes some company may go down for unforeseen reason. May not be anybody's fault.
Right.
Say, for example,
political reason. New government, new tariff.
New
tariff.
Everything.
You can't control it.
Or they may go up and down based on the tariffs, the way the fluctuation goes, the way the
new technology came. AI came in. Now half of the market is out.
Yeah. So that's exactly. So a lot of people pick. I remember last round there was people pick the insurance company. The reason you pick them because you think it's safe.
And insurance companies are one of the bigger holders of commercial real estate. That's one of their major assets.
And then when they ballot it up, everybody shocked because as an investor, you didn't take a risk. You did. You take risk. You take calculated risk, more safer risk. At the end, that one ballot up. It's now different. You bought a new company. You try to make quick money. So you never know. So for us, we always like to be more secure. So we like,
as you said, diversify.
Diversify
is the best. Yeah.
You have to have a little bit of everything.
Mm-hmm. Yeah. Absolutely. Let's talk now about this New Jersey withholding tax. If somebody sells their residence and they relocate to out of state, there's something in New Jersey that's like a holding tax or an exit tax, but it's really not a tax, but it's just that
but
let's
So this word exit tax has a lot of negative connotation around it.
Right.
People feel that the government is charging you, the state is charging you something more than what they should have charged. They're penalizing you because you are trying to move out of the state. Yeah. But that's not what the intent was. The intent was when somebody is selling a property in New Jersey, and let's say they move to a different state, Florida or somewhere else, it's very hard for the state of New Jersey to collect that money from them anymore. Because they have moved out of the state. They have no nexus with the state. How do you collect money from them? So the exit tax was initially brought in for non-resident people or part resident, people who are moving out. of the state. So state of New Jersey takes some money upfront from them.
Right.
Which, I mean, they have their own way of calculating. They say 8.97% of the capital gain. And there is a form you can file, say bulk tax form. You can file calculating that this is what I bought it for, this is what capital improvement is there, this is what I paid in commission, and this is what I'm selling for, this is my capital gain. So the state takes either 2% of the total sale or 8.97% of the capital gain that you are calculating. And this is more of an estimated tax that you have been paying every quarter anyway.
Sure.
So once you collect this estimated tax, at the end of the year, by filing the tax return with the state, you can show on your tax return that this is the advance tax that you had paid.
Right.
And if you did not have to pay, if you really did not owe it, you can get the money back from them.
Actually,
Right,
I
and you
have
have
to
clients
thank you.
who- yeah.
Remember last time you were here, I asked the question. I said, does the client, they bought a property here as a second home because he has an office in California and then he opened another office here. So he want to grow here, obviously. But he bought a property because he doesn't want to live in a hotel. He like his own kitchen. He like his own bed. So he bought a condo. And then he just bought it about a year later. The COVID hit. Everything shut. So at that point, he didn't come back for a year, less than a year. So he bought for 8 months or something, and then he didn't come back for a year. So less than 2 years. But that was his second home anyway, just like he's here. So he had to sell, so they put a withholding tax. At that time, when we had the show last time, I asked you, does he need to get in contact with you to get the money back? You say no. When he fill in here California, he can do that. The California CPA can do it. And I called him up. I told him that. They did it. They got the money back.
Yes, absolutely.
Yeah,
absolutely.
I called him. I said, hey, I have an answer for you.
Yes.
Oh.
Yes, absolutely.
Yeah.
Absolutely.
Yeah.
So a lot of time people get confused and people feel that they need a special CPA, a special accountant to get their money back. And we tell everybody, I'm not special. Anybody, wherever you file your taxes, at the time of filing your year-end taxes, this money will automatically come back to you. You don't have to do any special form filing around it.
I see.
It's just an estimated taxes that you are paying every quarter anyway.
You just have to remember to declare it,
That's right.
on the form,
Yeah.
on your filing
Very well
form.
said.
You have to remember to
Yeah.
file.
Absolutely.
Yeah.
Otherwise, the IRS won't give you, won't
the
remind
onus-
you, or the
no,
state won't
nobody
remind
will
you to say
remind
that you forgot. Here's, by the way, we owe you.
Nobody does that.
Yeah.
The onus is on you to claim what you should have claimed.
Yes.
Right.
If you pay less, we are happy to get back to you.
Right.
If you are paying more or if you forgot to claim a deduction or a tax, nobody is telling you that you forgot this thing.
Yes.
Right. Right. And we should go back now. We spoke about deductible expenses when we talk about investment properties. We should also highlight what improvements are not deductible in the current year, like in terms of capital improvements, like a new roof, a new
Absolutely.
appliances,
Absolutely.
maybe those things you can't really deduct
So
as
anything that helps increase the value of your home, generally speaking, are referred as capital improvement. It adds to the cost basis. You can have the depreciation increased around it. Anything that's classified as repair in general, or this tile is not fixed, so somebody came to fix the tile, the bathroom is not flushing, somebody came to fix the bathroom, those repairs are claimed immediately. They are not capital improvement. They are not generally increasing the value of your home. But if you are changing the sidings, if you are changing the roof, if you are changing the HVAC system, as opposed to fixing the HVAC system. If you are fixing the HVAC system, it's repair.
Right.
Claim it immediately. But if you are replacing the whole HVAC system, it will last forever, at 20, 25 years, hopefully.
Yeah.
So that's a capital improvement that you can add to the value of the house and then increase the depreciation accordingly.
I see, right. And a roof, I guess, would be debatable, right? If the roof is in need of immediate, is roofs normally, general guidelines are normally allocated as capital improvements? As
Roof is generally capital improvement. It's a large amount of money.
Money, yeah.
And it lasts at least 20, 25 years.
years,
Now
yeah.
it's 50.
Now it could be,
Our
yeah.
wife-
Exactly,
50.
exactly. But let's say if your roof is leaking and you got somebody to patch it up, to repair it, that's not improvement. But if you're
Right.
replacing the whole thing, that's improvement.
Yeah, that's a good guideline for differentiating between a repair
Yeah.
versus a capital improvement. Yeah. So that's good. Well, we're just about almost out of time. So we want to thank you for being our guest and agreeing to come back next week. We're going to talk about some of the newer enacted legislation affecting taxes, in the federal level and the state level. But once again, Ajay, please give your full contact information, where your firm is located, your phone number, and if you have a website too.
Absolutely. So Ajay Kumar CPA. My company name is SAI CPA Services. Our head office is in East Brunswick. You can reach us at 908-888-8900 or 908-380-6876. The website is www.saicpaservices.com.
Yeah, and we have about another minute. So besides being highly qualified CPA, you also do wealth planning, investment planning, a multitude of things besides just the normal accounting. So
absolutely, and it has to. It goes hand in hand. Unless you have the right licenses around wealth planning, you can't really guide the clients if they should be doing 401k, IRA, SCP. There are a lot of qualified investment that the taxpayers can do to reduce their taxable income. So when you have the CPA licenses only, you're missing the half picture. That's why right from the beginning, the idea was to have MBA in finance, CPA, wealth planning licenses, Series 7 and Series 66 licenses, business valuation licenses, so we can give all rounded guidance to our taxpayers.
Yeah, that's invaluable. Great. Well, thank you again so much. We look forward to having you join us again next week at the same time.
Absolutely.
For more information. All right. See everyone next week. Hope you enjoy the show.
Thank you.
Thank you.